Choosing the right mortgage is one of the most critical decisions you will make when buying a home. You might not know this, but there are many mortgage options available, each with its own terms, interest rates, and payment structures, which can make the process feel overwhelming. But don't worry, because in this video, we will break down the 4 key types of mortgage loans to help you find the perfect match. Let's start with the conventional loan. A conventional loan is the most common mortgage option used by home buyers, and it's offered by private lenders such as banks or credit unions. To qualify for this type of loan, you will need to meet a few key requirements. The first one is the down payment. The minimum down payment required for a conventional loan is 3% of the home's purchase price. However, if your down payment is less than 20%, you will be required to pay for private mortgage insurance known as PMI. Since a lower down payment makes you riskier in the eyes of the lenders, PMI is designed to protect the lender in case you stop making your loan payments. This insurance typically costs between 0.3% to 2% of the original loan amount each year and is usually paid monthly along with your mortgage payment. For example, if your loan amount is $500,000 and your PMI rate is 0.5%, your annual PMI cost will be $2,500. That breaks down to a monthly payment of about $200. And typically, you would have to pay PMI until you have paid off about 20% of your loan's original balance. But here's something important to consider. Many people choose a down payment of less than 20% because they haven't saved up the full amount, which is understandable. However, the issue often goes beyond just falling short of that 20%. In many cases, buyers are also draining their entire savings just to afford the home. And this is where the real problem lies. If you decide to buy a home, it's crucial to ensure that you have substantial savings set aside, enough to cover several months of expenses in case of emergencies or unexpected home repairs. Remember, taking on a larger loan means relying more on borrowed money. This is called leverage, and high leverage without a solid financial cushion can be very risky. Never stretch yourself too thin. Without sufficient savings, you could find yourself in a difficult financial situation. So before making any decisions, make sure you are in a strong financial position to handle the responsibilities of home ownership. Another important factor for qualifying for a conventional loan is your credit score. In most cases, you will need a credit score of at least 620 to be approved. However, the higher your credit score, the more likely you are to receive better interest rates and terms. Lenders will also want to understand how much of your income is already committed to paying debts and how much is available to cover your mortgage payment. They use a measure called the debt to income ratio, DTI. For a conventional loan, lenders typically prefer a DTI ratio of 36 or lower. For example, if you have $1,600 in monthly debt and $5,000 in monthly income, your DTI ratio is 32%. Again, for an ideal scenario, you should pay off consumer debt before taking on a mortgage. Doing so puts you in a better position to afford your home and enjoy home ownership without the added stress of juggling multiple debts. Just because you can be approved for a mortgage with a DTI of 36% doesn't mean that you are truly capable of assuming such responsibility. Lenders only care about receiving their cut. They don't care about you and your struggles. Buying a home is one of the biggest financial commitments you will make in your lifetime. It's not a joke, and you have to approach this decision with careful planning. Lastly, when choosing a conventional loan, you will need to decide between two types of interest rate structures: fixed rate mortgages and adjustable rate mortgages. With a fixed rate mortgage, your interest stays the same for the entire term of the loan, which could be 15, 20, or 30 years. In contrast, an adjustable rate mortgage starts with a fixed interest rate for an initial period, such as 5, 7, or 10 years. After this fixed period, the interest can adjust based on market conditions, which means your monthly payments could increase or decrease. Next up, we have FHA loans. An FHA loan is a mortgage program offered by the Federal Housing Administration, which is a government agency. These loans are designed to help make home ownership more accessible, especially for first-time home buyers or those with less than perfect credit. You can qualify for a FHA loan with a credit score as low as 580 and purchase a home with as little as 3.5% down. If your credit score is between 500 and 579, you can still qualify, but you will need to provide a 10% down payment. Because these loans are designed for borrowers with lower credit scores, lenders require protection in case you default on the loan. This is not the same as the PMI. This is a separate mortgage insurance that is composed of 1.71% that can be paid at closing, but most borrowers choose to finance it into the loan amount. Additionally, FHA loans come with certain property standards and loan limits. The home you want to buy must meet specific quality and safety standards, meaning it has to be in good condition and safe to live in. If the property needs a lot of repairs, it might not qualify for an FHA loan. There's also a cap on how much you can borrow. This limit varies depending on where you live, but for 2024, the FHA loan limit for a single family home in most areas is $472,000. Finally, you must live in the home as your primary residence. This cannot be an investment property or a second home. Now, here's my take on FHA loans. While it can be a helpful tool for some, I believe it's important to approach them with caution. The main advantage of an FHA is that it allows you to purchase a home with a low credit score and a low down payment. But here's the reality. If you are in a situation where you need an FHA loan, it might be a sign that you're not financially ready to make such a significant commitment. Rather than rushing into home ownership with a low credit score and minimal savings, I would encourage you to focus on building that solid financial foundation first. Work on improving your credit score, paying off debt, and saving up so that you are not financially drained after the purchase. And listen, there is absolutely nothing wrong with renting in the meantime. Renting gives you far more flexibility compared to being over leveraged, paying for mortgage insurance because you are seen as a risky borrower and potentially struggling with your mortgage payments. So while FHA loans might seem like a quick solution, I think you should take the time to get your finances in order. And when you're ready, you will be in a much better position to enjoy the benefits of homeownership. Next up, we have VA loans. A VA loan is a mortgage option guaranteed by the U.S. Department of Veterans Affairs, specifically designed to make home ownership more accessible for veterans, active duty service members, and eligible surviving spouses. This program offers better terms and significant benefits compared to conventional loans, making it an excellent option for those who qualify. One of the standout features of VA loans is that there is no down payment requirement. This means that you can finance 100% of the home's purchase price, and unlike conventional loans, VA loans do not require PMI even if you don't make a down payment. Another significant benefit is the interest rate. Because the Department of Veterans Affairs guarantees a portion of the loan, lenders are able to offer lower interest rates. However, there is a fee you will need to be aware of, known as the VA funding fee. This fee helps offset the cost of the loan program to taxpayers. The amount of the funding fee varies based on several factors, including your military category, whether it's your first time using the loan benefit, and the size of your down down payment if you choose to make one. The fee typically ranges from 1.25% to 3.3% of the loan amount, and it's an important cost to factor into your overall home buying budget. I recommend checking the VA's official website for more details on the eligibility requirements, which I will leave linked below. Another type of government-backed loan is the USDA loan. The USDA loan is part of a program designed to promote home ownership in less populated regions, such as suburban areas. Similar to the VA loan, this program doesn't require a down payment or PMI. And because it's backed by the government, it not only offers the option of 100% financing, but also provides competitive interest rates. However, the USDA loan program does come with a cost known as a guarantee fee, which helps keep the program sustainable and available for future borrowers. To qualify for this program, first and foremost, the property must be located in an area designated eligible by the USDA. You can check their website to verify if a specific property qualifies. And in addition to the property location, you must meet certain income requirements. Typically, your income should not exceed 115% of the average income for the area in which you plan to purchase a home. Another important factor is your credit profile. While the USDA does not set a strict minimum credit score, most lenders look for a score of at least 640. Most of us will only qualify for the conventional loan, which is the most common mortgage option out there, but understanding the different types of loan, whether it's FHA, VA, or USDA, can really help you see where you fit in all of this. Each loan has its own set of requirements, benefits, and potential downsides, and your unique situation will determine which one is the best fit for you. That's why it's so important to equip yourself with the knowledge of what is available and how each option works. And remember, buying a home is one of the biggest financial commitments you will ever make, so don't rush the process. Take your time, and if after this long explanation you find out that you're not ready to buy a house, there are other ways to build wealth, and yes, renting is okay. If you found this information useful, don't forget to like and subscribe. Thanks for watching, and see you next time. Bye-bye.